Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.
Hello, welcome to another episode of Sparta Market Outlook, episode 47. So I'm delighted to be joined today by June Go, all the way from Singapore. Welcome, June.
Hi, thanks everyone.
We also have Jorge Molinero back with us on Light Ends. Hi, Jorge.
Hello, Rachel.
And of course, Neil Crosby is here as usual. Hello, Neil.
Good morning.
So look, we've got a packed agenda today, but thankfully not too many headline-grabbing stories. I think we're all feeling a bit fatigued from watching the news of late, and I suspect that many of our listeners are too. So instead, we've got a more data-led episode. So we're going to be diving into the details on arbitrage, refining, crude slates, and actually what's happening at Cushing. So look, before we jump in, a quick note from myself. Sparta is hosting a live panel event tomorrow evening, Thursday the 3rd of July in London. So we're going to be joined by guest speakers from OB, GX and Phoenix, followed by our Spartan summer drinks. So if you're listening and in town, we'd love to see you there. Great speakers, good conversation, and hopefully a few drinks along the way. So look, let's kick off and get into some of the stats and recent news over the last week. Why don't we start with the latest on the US? Neil, I think this is one for you. So the April data's in. Any surprises in terms of crude output or demand pop up?
Some surprises on demand, maybe. I think of course, this is for April. That's the PSM numbers. And it kind of confirmed that if we go with output, so US crude output up very slightly month on month in April, from a slightly downgraded March level, if I recall. I don't think it's too bullish or bearish. I think it's basically about what the market expected. I think the next question is just where do we go from here? Because the last STIO forecast we had from the EIA itself suggested that April will be the peak in US supply. Okay. And after that, levels are going to slowly decline. And I think that's basically what the market, I don't know if it's consensus, but I think that's a reasonable forecast, let's say. At the same time, a lot of people are watching some of the key stats, right? Drilling activity, the active frac spread counts, they all continue to drop. And okay. We'll have to see. It'll be interesting to see the next steel forecast over the coming weeks.
Okay. When is that out, by the way?
Oh, good question. Isn't it mid-month? I think it's close to mid-month. It might be even sooner than that. Horrible question. I don't know dates.
It's on the calendar somewhere with us.
It's on the calendar somewhere, yeah. We'll find
8th of July. I got it 8th of July.
Okay, brilliant. Thanks, June.
And the other thing, just a note there, because a lot of people are watching the non-OPEC figures, right? And the key ones are kind of what's the US going to do, what's Brazil going to do, what's Guyana going to do. And just a note there, we got the May supply numbers for Brazil. Those are back to 3.7 million barrels a day. That is basically the peak it reached at the end of 2023. So it spent a long time being quite low, surprisingly low. And now it's really ramped up the last couple of months. And the expectations are that there'll be more FPSOs coming on stream in Q4, which will bump up the numbers even more. So it's just one to watch, so to speak.
Okay. And where do we get to on demand on that one?
Yeah, I think demand is good. I think US demand is showing up quite strongly. So sort of finished, I'm quoting some year-to-date numbers here, right? Finished petroleum products up 275 KBD year on year, of which MoGas is 71, Kero is 25, diesel is 144, plus 144. I think the US diesel demand looks very strong. There was obviously a colder winter. And the other thing that is interesting is that there definitely were, someone put me onto it this week, the rail stats, the rail freight, essentially, statistics were quite strong at the start of the year. And there's some commentary thinking about, maybe that was front-running tariffs. And the stats are actually looking a bit poorer over the last couple of weeks. So maybe that will influence diesel demand figures going forward. And we know that the weekly stats are bad just now. But they are always should be taken with a pinch of salt. The other thing that spoke to me was the biodiesel stats, biodiesel demand in the US. is dropping quite strongly. So if you count renewable plus bio together, the year-to-date numbers are minus 100 almost. I think that's quite interesting. That is, all things equal, probably advancing the call on the fossil side of things. So yeah, interesting set of stats. I think US demand at the moment is looking pretty good.
Okay, keeping an eye on biodiesel then in that case, and some rail kind of numbers. Look, one thing that has popped up in the headlines this week, we all know that there's an OPEC meeting on Sunday, lots of speculation going on around that. So what's our take going into that?
I mean, June, you can add anything you like, but I think there's always a question of heading into an OPEC meeting over the weekend, how do you position yourself? And I think the market is possibly, I mean, I'm expecting another hike. Yeah. There's just two perspectives here, or multiple perspectives, but two ones I'm thinking about. You can tell from spreads and from low stocks, low crude and product stocks in the OECD, that on paper the market can afford more supply. Against that part, we all have cottoned on to the story that OPEC has been hiking. Some of it is a kind of ghost barrels because they were already on the market. Some of it didn't reach the market probably because of crude burn and a few other things. And so we have this flat price, which is now below 70, which I guess OPEC won't be too happy with regarding their budget, although I can make a story that says, you know, they might be relatively happy given what's been going on this year. But the flat price under 70 also already reflects a little bit the Q4 balance, which everyone's still expecting to be long, partly because of OPEC barrels themselves, OPEC hikes. So I'm not quite sure where this goes. I think we'll get another decent hike. I can see something emerging where they say, okay, we'll do another 400 or maybe even 800, and then they say, but we'll do a pause after that, and just see how the market reacts to that. Because so far, on paper, they've hiked a lot, and flat price is all right, I would say, given all that's been happening. So interesting sort of strategic perspective for OPEC going forward. Okay.
And you think the market can take it?
I'm looking at spreads and I'm looking at inventories, and it looks like the market can take more barrels, let's say. But the question is whether they are already due from the levels that OPEC are already producing, or whether OPEC needs to actually hike physically more in, September, October.
Fair enough.
August, September, October. Yeah.
Very much looking forward to your 400 or 800 KBD kind of in addition prediction next week then. We can follow that up. So look, June, let's turn to you. So we've seen a bit of a shift in buying behaviour from the Asian refineries recently, especially in light of the ongoing tensions in the Middle East and so forth. So how is the news psyche around crude diversification playing out in the market? And what is your view on what shapes kind of the September loading demand?
I think the big question is the Iran-Israel ceasefire going to hold? For Sparta's view, we know that warfare is non-linear. Any small action could prove a flashpoint eventually. And the market will be quick to react again if there's a return to conflict. So for Asian refineries, particularly who depend on this AG crude as base feedstock, I believe they will try to err on the side of caution for supply risk. On top of that, many refineries here are configured for a medium sour diet. De-risking freight options from the AG is kind of limited. Expectation-wise, crude supply diversification is the key theme for this upcoming July trading window for September loaders. Maybe what the refineries will do is, instead of buying a full slate of traditional AG crude, they might start to buy at least one more marginal non-AG crude as part of their base case supply, just for supply security. And with this view, we believe that then the AG crude diffs could trade lower and weaker than last month. Also, there's an expectation of incremental OPEC plus supply barrels. And we have the TA season in Asia peaking in October, which is partly the September loader buying this month.
Yeah.
And we have this thing called the crude signals dashboard right now in Sparta. Looking at that, we see WAF light and even 40s could benefit as the next best alternative versus a very surely cheap AG market. WTI currently doesn't look that advantageous as the next best up crude, but I'm going to expect to hear more of WTI cargo spot anyway, as probably a leverage for bilateral trade negotiations with the tariff discussions with the Asian buyers.
Okay.
On the cash diff side, Melbourne and Oman may not see the same advantage location premium versus the height of the tensions now that the risk is more generalized over the shipping route in the Middle East Gulf versus an outright Straits of Hormuz closure. ICE Melbourne started the month trading at about Dubai plus $3, and I think we need to wait for the Saudi OSP release coming up pretty soon and at the ADNOC allocations before we have a clear signal where the crude diffs will eventually head. Just a market update as well. SEP Brent Dubai EFS is now back to about $160 per barrel compared to $3 per barrel at the height of the tensions. It's still not an easy trade to call right now whether to short or long the EFS because any flare up in geopolitics will still lead to Brent blow up and therefore EFS blowing up as well against the fundamentals.
Yeah, okay. Interestingly, you picked up on the crude signals dashboard. I mean, one of the, and Neil, it's probably one for you to talk about kind of TI Brent, but there's certainly been a change in that this week, that's for sure. I was looking at it on Monday and the picture completely flipped kind of on opening on Tuesday. So we've seen some pretty extreme tightness. We talked about that last week in Pad 2 and Pad 3 recently. So are we starting to see the signs of that ease in? What does that mean for the export flows out to the US Gulf Coast and differentials as we head into July then?
Yeah, I mean, just to pick up on that then, one of the things that I sometimes struggle with, I guess, is whether or not you can truly, because everybody's got a Pad 2 balance and then a Pad 3 balance, and those two things are connected, right? So even though you can talk about Cushing in its own right, export economics do play a role here. Yeah. And the one interesting thing about US crude stocks is that Pad 3 stocks have been drawing really, really heavily over the last few weeks. And I think that partly reflects all kinds of things like strong runs. Probably Permian inbound flows were lower because the Midland versus Cushing diff was attempting to, let's say, put Permian flows directly to Cushing rather than to the Gulf Coast. That's one of the things that Cushing is trying to do. It's trying to stop flow from Cushing to the Gulf, and it's trying to pull Permian barrels north, so to speak. So just in that context, you know, that, as you said, the export econs have actually started to look a bit worse. So if we're looking at our ARBs signals dashboard, the TI MR or TI AFRA ARB to Europe was looking cheap. Today it looks like a 1, which is basically the most expensive it can be. And the reason that has happened is that the 40s FOB has completely collapsed, which is something we thought might have to happen.
Yeah.
And the other thing that was making TI look cheap in Europe was the fact that certain other crudes in the wider basket were overvalued. The main one, for example, was CPC, or Azeri Light. All the Black Sea crude did look extremely expensive. And actually, I was going to talk about this yesterday, but overnight, CPC's corrected $1 per barrel, actually. So that's part of the reason why TI now looks relatively more expensive in Europe. And in Asia, it's interesting to hear what June's saying in terms of it being like a strategic purpose, but strategic purchase. But TI doesn't look particularly cheap in Asia right now either. So on paper, the export econs are not that great for TI all of a sudden, if you like.
Okay.
And just to add, just where does this fit into the TI Brent story? So August TI Brent basically expired really, really narrow. And now, I need to look at the platform. I think we're at basically minus $3 per barrel, which is quite a bit of a loosening. Yeah, we are. I think the story here is that Pad 2 and 3 tightness should begin to ease, and that is partly what prices are telling us already. So if you look at the location diffs, those are already reverting, so to speak. So MEH has been priced up against Cushing already. That's something that suggests stabilization. Yeah. And the other two things in Pad 2 are imports were super low last week, and we think that's due to the wildfires specifically. So it should revert or ease. And the other thing is Pad 2 runs were extremely strong last week and the last couple of weeks, even for the time of year. And that should also revert. And there's some expectation of decent TARs coming up in Pad 2. And it's kind of the same story for Pad 3 tightness, right? So eventually we're going to see more flows drawn in from the Midwest and Permian, and the export econs are coming off, and refinery runs also, I guess the risk is down from here, particularly looking at things like hurricanes. Obviously you can't really forecast that, but I think on the whole, the tightness in the US probably peaked already. And perhaps TI Brent reflects that.
So last week's story, bit of a correction this week, and see how we go with imports kind of into Pad 3 and certainly into Pad 2 over the next week or so. Okay, we do have a bit of a special. So June, last week when we were on the pod, we talked quite a lot about feedstocks. So the VGO market has been on a bit of a tear. So we've seen spot values in the US Gulf Coast jump sharply. Margins for complex refiners continue to widen. So what's driving this move? And is this more about a squeeze on the gas oil supply than a demand shift itself? So keen to get your take on this.
Okay, first of all, we saw the spot VGO price in the US Gulf Coast jumping from ICE Brent plus $9 per barrel up to $15 per barrel this week. The VGO trend in ARA pricing wise also went up similarly. But in terms of supply, we don't think it has significantly changed. But the big change is probably the valuation of VGO increasing with gas oil cracks also increasing in the market. And that is therefore incentivizing incremental runs into the hydrocracker to make more middle distillates. If I look at the refining complex margins, it's stronger versus the simple margins using our Sparta indicative refining margin indicators. Like for example, in May, I was looking at $4 per barrel simple margin, and that was a high sulfur fuel oil strength story for the simple margin, a $9 per barrel complex margin at times, so indicating a $5 per barrel spread between complex and simple. Today, that number is now $3 per barrel for simple and $10 per barrel for complex. So the spread has now increased to $7 per barrel. So this is kind of a reflection of the need to convert more receipts and VGO into lighter products, particularly middle distillate. And I think we think that gas oil demand didn't significantly change that much. So surely this is kind of a supply issue then from the gas oil side. What we are looking at in terms of inventory data, US and ARA receipt, both receipt and the gas oil side is at its lowest point in years. It's suggesting that refiners probably they're not getting the heavier feedstock that they need to convert the residue and the VGO into gas oil.
That's really interesting because we were talking about it last week in terms of whether this was a heavy crude or lack of heavy crude kind of in the market story. So we've got a gas oil, or we've got a distillate kind of part in the conversation where I think we'll cover crude slates anyway. But look, alongside VGO, low sulfur fuel oil cracks in Northwest Europe are also at their highest level in nearly 3 years. Inventories in ARA are sharply down. So what's driving this tightness, and how are the blend economics shaping for the regional supply dynamics across Europe, Med and say Asia for this one as well?
Okay, so I'm just recapping on the VLSFO cracks. It's at probably near 3-year highs in Northwest Europe. ARA inventories are about 30% down on the year. Reflected in the current steep prompt backwardation. Med VLSFO blend margins are looking a bit weak in our blender as well. So is there a connection with the VGO market story that we talked about? Yes, but the actual supplies of VGO into the VLSFO market has been quite small to start with. So we don't think it is a direct relationship to the VGO strength leading to VLSFO strength cracks in the market. And likely more is the inventory story. Singapore and Fujairah VLSFO side, when we look at our own blender, it is healthy blend margins. We are seeing about $10 to $13 per ton levels, excluding tank costs, which indicates that blenders here should be incentivized to produce more VLSFO in the region. We also notice mid-sulfur barrels like Taiwan MCB, West Coast India CBFS, and South Korea 1% slurry are also in the money into the VLSFO pool instead of the high sulfur pool where it was before, like 2 weeks before. Dangote LSSR as well, it looks like it's pointing to Singapore still, but Fujairah is starting to look interesting there and more in the money for this component. So we have got to start seeing whether the flows actually work now into Fujairah. And just before I got here, I think Hua is going to write a trade idea for this fuel oil commentary, so watch out on that point.
Brilliant. Okay, cool. Well, if Hua produces that this week, then it might be a good start to get him back on for next week just to see how that played out. Thank you so much, June, for that one. So Jorge, you've been very quiet so far on this pod, so let's switch to the light ends. Keen to get your update on what's happened over the week. But look, Naphtha's been weak in Europe. The East-West arb is wide open, though, and spreads are snapping back. So do you think that this is a temporary correction, or are we seeing signs that Asia demand might be the only real lifeline that we've got this summer?
Yeah, I think to recap a little bit, what we've seen during the end of last month was very big downtrend after the ceasefire. So the market was very supported on the Naphtha side. Yeah, if we are missing Middle Eastern barrels in the market, Asia relies more on Europe. So they raise a lot the cost diffs in the East, also East West. Yeah, it supported the market during 2 weeks in June. Right now the market is much weaker. So we saw levels, especially in Europe, lower than the ones before the start of the conflict. And yeah, I think last week we were pointing that the market could have gone too far. because we saw contango in the first two lines in the European market, and we are seeing also during the beginning of this week negative premiums in Northwest Europe and in the Mediterranean. So right now the ARB, East-West remains very, very strong, above $25 per metric ton. So that is making the ARB very open into the East. We were talking about this can be a support of the market, and we have seen a little rebound. So the market right now is trading in backwardation again for Northwest Europe, and the ARB is still very, very open. Weak FOB in Europe and a very strong East-West. So despite the big drop in cash diff in the East as well, I would expect that the market will keep supported in the short term. Basically because the margin is huge, it's the biggest value that we have seen for margins during this year. So this, I don't think we will see contango hit in the European market during the summer. But in the medium term, it can be weaker because, as you said, everything is relying on Asian demand, and petrochemical margins are not doing well there. So we could see some weakness in the medium term, yes.
Okay, so cargo's still flowing then in that case, and we'll keep an eye on petchem margins in Asia going forward for that demand correction. Where did we get to on EBOB over the last week? So I think Europe's continued to trend lower, right?
Yeah. I think same way than in Naphtha, we saw a big drop during the end of June. We have some differences. The Western market has been much weaker than Singapore one. And in Europe particularly, one of the main reasons is a very big margin for E5 and E10 local arbitrage. So going to the market, buying the components and sell them in the window. And this is being very bearish for the European market. But in the same time, and we have seen a drop also in gas now. So despite naphtha has been weaker, gasoline has been even more weaker in Europe. But I think yesterday we saw a small rebound, and East-West keeps very strong, and there are many arbitrage opportunities right now out of Europe. So I think we might have seen the lower values of this trend in the West, because in Europe right now there are many ARBs open into East Africa, also into the Atlantic Basin, and in US we have this lower stocks picture that Nils has been talking about. So I think the market will be more supported in the medium term.
Okay, so continuation of last week then. Looks like kind of European gasoline barrels are heading pretty much everywhere, so one to keep an eye on there. Brilliant. Anything else from your side, Jorge, before we kind of jump through to the middle distillates part?
No, I think that's all. I think moderate bullish for the light ends, especially for the western values, and the main reason would be that on naphtha a very strong arbitrage to the east, and in gasoline we are seeing a lot of arbitrage open from Europe and lower stocks in US.
Brilliant. Okay, cool. So Neil, over to you on middle distillates to probably carry us home, actually, because I think we've done a round robin of kind of the full oil barrel nearly. So look, we've seen jet regrades collapsing, gas oil spreads widening, cracks rallying, freights all over the place this week, and crude slates looking awfully light. And we touched on that earlier, kind of on the feedstock side. So June, I'm going to bring you into this one too, actually. So is this just noise, or are we seeing something a bit more fundamental starting to shift in the distillate complex, do you guys think?
Good question. I'm not quite sure. So let me just take us through what has happened. So since the last pod, I think we were debating whether the July-August ICE spread would need to blow out or not, or even collapse. I'd say blow out. So now I think back then we were talking about ICE July, August at plus 15. Now we're at plus 25 as we record. So massive. And I guess that partly reflects the fact that ARBs are still closed, and they've been closed for a while, and perhaps it answers the question as to whether the flow that was flowing out of the US has been enough. And we know, because we've seen some basically pictures of ARA stocks. ARA stocks are low, so it looks like it's kind of fundamentally justified. We're about 10 days from expiry. I'm not sure if we need to expire at plus 25, but we'll see. It could expire strong again. I guess the other thing that's happened is that there has been lots of bullish refinery news over the last week. So there have been loads of, let's say, I don't know, explosions and stuff. So there was a fire at St. John. Of course, it's all Atlantic Basin based.
I think it's called unplanned outages, by the way.
Fine. Hiccups. Unplanned outages. There's issues at Bayway. I think there was flaring at Beaumont, was a huge one. And of course, there was also the news about the Lindsey Refinery, which is another 100 kbd of processing, with its, I think it's Prax, is its parent company, basically going into administration. So the market's not sure whether it's still going to run next month or not. Plus, you had things like Haifa still off in the Med. I actually noticed that the Med, Northwest Europe diff, has risen quite a lot over the last week. Plus, there's a heat wave, and inbound, all the stories about the heat wave impacting refineries operations in Europe, probably which are slightly overblown. But I think in this kind of market where stocks are already low, maybe all these kind of headlines make a big difference. But I mean, it's kind of solved the mystery from last week. Are ice spreads going to blow out? Yes, they did. I guess the question now is, where do we go from here for August, September? Because we're about to expire with July. I think it's still largely a freight trade, right?
Okay.
So TC14 is highly backwardated, and it's partly when we're looking at our ARBs, right? So an August delivery ARB into Europe, it kind of looks like a monthly average value, but the spot value for our freight is basically reflecting the massive backwardation. So it's very strong for the next 10-day head window, but the kind of monthly average value, if I plonk kind of like 140 world scale into our numbers, at this rate, the ARB is now basically back to open, right? So in theory, if you look at it from that perspective, ice spreads, plus there's been a big jump in the EN 590 premiums this morning in Rotterdam. That's done enough to tempt more flow out.
Okay.
So just looking at that perspective, ice spreads have done enough, right? But the question, I guess, is also just, what's going to happen in the next few weeks if a few more refineries blow up, unplanned outages, or if we get another draw in US stocks or two, then yeah, I mean, the temptation would still be to say, once freight corrects and we understand a bit better where the ARB stabilizes, maybe be tempted still to buy August, September, as we basically said last week as well.
Yeah. Okay, so still pretty constructive, and risk to the upside then on supply.
I think so. It's quite difficult to tell at the moment for me because the freight market is so ridiculous right now, and it's genuinely a difficult time because we've talked about the July holidays in the US, and the other thing that is happening is that TC2 is so bad, TC2, and I think that does, speaking to David Thwaite, our freight owner this morning, that does impact the round trip earnings, right, from Gulf to Europe and back, and that is also stopping people from being tempted to move vessels into the Gulf, even though there's loads of vessels in ARA, and that's partly why TC2 is so bad. It's the round trip earnings are putting people off. So it's very, I mean, I think we come back next week and decide where freight has shaken out and then kind of restart again from there.
Yeah, it sounds like a Michael Ryan kind of return to the pod for next week in that case. Okay, what else has been happening in the distillate markets that's quite interesting?
Yeah, I want to talk about some solvers, right? So this may be where you and June can come in here. So what else is happening? The jet regrade is tanking almost everywhere, and that, I suppose, has more to do with gas oil strength than anything else. And that's typically kind of what happens when you get a big repricing higher in gas oil. And it's definitely telling us to shift some volume into diesel. And I think we ought to be thinking about this slate and lack of resid issue a bit more consistently. So maybe one for you guys. If crude slates in the West are too light, so to speak, does that mean, for example, that you produce a bit more naphtha and you probably produce a bit more jet over diesel? Is that a fair statement? Does it again impact your ability to make more diesel rather than jet?
June, do you want to take this first? But one caveat for me is that going into summer Jorge sat in 45-degree temperatures at the minute in Madrid, bless him, but going into summer with a very old refining setup, complex in Europe specifically, and running light crudes over summer is not where you really want to be, if I'm completely honest, because your fin fans are going to be having a right royal time trying to kind of keep pipes cool. So the risk of kind of it's the age-old story, right? The risk of old configuration kind of plus heat plus light crude slate plus creating kind of more of the gases at the top of the column causes you a little bit of operational issues. But I'm keen to hear from June on this one because she's had more recent refining experience than what I have. So June, what's your thoughts?
And just before you answer that, June, it's not just Europe, right? It's the US, because we were looking at some stats yesterday.
Yeah, fair.
You get the API, the average API of crude run through each pad in the EIA stats, right? So if you look at pad 3 in April, the slate lightened on average by a whole degree. What do you count? Degree point or API degree in April, year on year. So it's like a substantial lightening of the US crude slate in April, which, looking at the kind of import stats and things like that, probably continued. So and looking at the US jet stocks, which are, again, very high, also in ARA, it looks like we're producing too much jet.
Yeah. So, I think the API information, it is a key story to this, which, yes, if you have a lighter crude slate, obviously you will get lighter products. And the shift towards Naphtha is the biggest one to look for. Then it will be jet and then followed by diesel. So yeah, we are probably short diesel because we have less resid as part of the feed blend into the refinery. As to how, I would think that the price or the regrade should already incentivize people to blend off some jet into diesel as a starting point, but somehow it wasn't good enough a price spread. Maybe now is the time when it really does incentivize. I recall we were able to do up to 20% of jet move out into diesel blending back in my refining days. And secondly, in terms of the heat wave, no, actually in Singapore, we've never experienced that high to cause a refinery operation issue. So I don't have the experience.
Yeah, some of the consequences of that is that you'll get kind of refineries dropping runs to manage kind of the top end of the column, so all gases kind of produced. So for LP runners buying crudes for refineries now, crudes that have got a low butane, propane yield kind of to them, despite the fact that they're light, will be kind of in higher demand, obviously. So that's maybe something that we can look through kind of on the tool in terms of where some of those crude differentials kind of lay out and how that picture's looking. We've also got, to be fair, refinery LP that we can run ourselves. So probably some back testing for us to do going into next week. It might be a good idea, actually. Yep.
So maybe the OPEC plus barrels that coming out, they're all heavy, right? So isn't that the right fit for the current situation
it is.
As a solver?
Yeah, definitely. I mean, from the quality perspective, OPEC have another reason to say, okay, we can afford to put more barrels into the market, because the sort of long and the short of it is that distillate cracks are moving higher, partly because of the slate, right?
Yeah, right. So where are we going to lay out on this one then, in that case? I think it's wait and see for Sunday. We are definitely still kind of short of feedstocks to a certain extent to lighten or to heavy up our crude slates. We're going to continue to keep an eye on kind of some headline driven news kind of on refinery operation, and maybe we can take a look kind of internally about where the diffs are laying out with some certain crudes basis their assays and what's that looking like, and recap on that next week. Is there anything else kind of that we need to cover in terms of refining side or crude slates or distillate?
Yeah, I mean, maybe just another comment. I mean, when you look, I mean, a question for you then as well. Do you only run lower basic on the days when the temperature is at a certain level, and then the other days when the temperature is back to whatever it is, 28 degrees, you're basically running fine? Is that a true statement? Yes
and no. It's actually quite hard to, I mean, you can drop crude runs for certain, I mean, this is going back nearly 20 years since I was actually kind of at a refinery, Neil, so you're testing my memory.
Oh, yeah. Sorry.
But yes, to a certain degree. But I mean, refineries are like big, huge tankers. They're not kind of an on-off switch really, where you can kind of derate and pull up. So there'll be marginal movements that you can make to support that. But it's more about the load on the cooling systems that the refineries have got. And typically, as I said, Europe has got probably the oldest refining system in the world still. There have been there have been efforts over the years to kind of improve that, but European margins are always lagging behind kind of everywhere else. So yeah, investment kind of there from this standpoint is always kind of a bit tricky and a tricky call to make, which is why we've seen so much divestment in Europe, right?
Yeah.
June, your thoughts? You probably have got more experience in rating crude towers quicker than what I've got.
Yeah, you definitely can tune the unit to whatever temperature. If there's a temperature fluctuation, we try to tune it to a higher level when it makes sense. But if from a refinery run perspective, operations-wise, they won't really like to do that up and down. They'd rather keep it at a steady state so that you can get the maximum operational handles to manage for any other unplanned. So it could really does mean in our balances a slight underrun of crude versus what is the planned max, declared max as a result.
Yeah, I mean, the reason I say this is because it's like a headline story, right? Because I think last time in 2023, the headlines coming around from banks. Of course, banks have a potential reason to be putting out these things, saying that the impact on med runs is going to be 1 million barrels a day. And the question is, is it 1 million barrels a day for 5 days, or is it, a monthly average type thing? And if you look at the data, the crude runs data, it's definitely not 1 million barrels a day over the course of a month. It's a much smaller impact. But the headlines, just like with the hurricane, are going to be, buy some gas oil cracks, basically, or spreads.
Yeah, June's right. If you're making big swings to kind of your refinery operation setup, the risk that you have is putting everything off spec. So consistency is key. As I said, there are marginal stuff that you can do, but it won't be I'm going to take 50 kbd off my crude tower because that'll literally put quite a lot of products or streams off spec and cause you issues kind of further down. So, okay. Carry on.
One last one there. And the one thing that I keep getting pinged about is the gas heat trade, right? So it's not, the thing is, when the Iran story hit and gas heat blew out, the natural reaction is to say, okay, at some stage this will correct. But there's more and more people discussing, at least with me, and me kind of agreeing, but not very sure. Will this correct in the way that you think it will? Will gasoline begin to price up against diesel again anytime soon? And you would think it would, because we're heading into max gasoline demand season. And just from the thought process of, okay, there's maximum incentive to produce distillate at all refineries. But if we say we're going to struggle to do that, maybe it's not a very good trade, gas heat correction over the next, let's say, few weeks at least.
Yeah, I was going to say, I think this comes back to timing, right? Yeah. Because we're not going to have a correction in the next couple of weeks where we see heavy crude come back to the market as a solver for your light crude slates. So for me, I would see that past probably end of August going into September. By the time we've actually got barrels in, by the time people have actually brought it into the refinery, put it into their crude tanks, and it actually show up in the crude slate. I mean, every refinery's got kind of a different buying cycle, but if you're looking 4 to 6 weeks out, if a cargo kind of arrives today, by the time it gets processed, I mean, June, what are your thoughts? I don't think it's going to solve itself in the next 6 to 8 weeks.
No, I don't have anything new to add, really. I think it is a prompt versus a forward run situation. Yeah.
And you can see we've got a Naphtha problem, right, Jorge? I mean, there's definitely a relative Naphtha problem already, which probably helped to drag down EBOB spreads last week, or the start of this week, as you basically said. So assuming that kind of continues, it makes things difficult for gasoline. Maybe that's one thing you guys can pick up on next week. If there's a big Naphtha oversupply problem, what does that mean for gasoline over the next few months or weeks?
Yeah. And I think, in line with that, we have seen this drop in gas NAP during the last 10 days or the last week. But I will expect that we will see a reversal on this indicator.
Okay. One to watch then. So we've got gasoline heat, crude slates conversation continuing, and let's see where we get out at OPEC in that case. And June, thank you so much for kind of the snippets on the feedstocks. That's been really, really insightful and very helpful. So look, that's all from us this week's episode of Sparta Market Outlook, and thank you so much for tuning in. So a big thank you to June, Jorge and Neil for sharing their insights, and as always to our listeners for joining as we unpack the data, the differentials and the dynamics shaping the market. So don't forget, if you're in London, join us tomorrow evening, please, for Sparta's live panel event. Smart people, sharp views, and a drinks tab that we probably will regret. But look, we're going to be back next week with more market moves, more charts, and as always, just enough volatility to keep us all pretending that we saw it coming. So until then, stay safe, stay cynical, and remember, if in doubt, we can always blame the freight.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.